First of all, I want to talk about how to choose the right stockbroker. Before investing in the stock market, you'll have to sign up for a trading account from a stockbroker so you can use that account to buy and sell shares and manage your portfolio. But the thing is, there are a lot of stockbrokers out there, and maybe you have no idea of which one is the best for you and your trading needs. You see, some stockbrokers offer a very good service, while some are lousy and they come up with many hidden fees. So I think the most valuable information for you is how you can find a good stockbroker who can help you make your investments. Okay, there are 3 important criteria that I always use to determine if a stockbroker is good for me and my trading needs. The first thing, they must be reliable. Remember, when you use a stockbroker, you'll have to deposit your money into their brokerage account. And this simply means that they'll keep your money and help you make investments on your behalf. So, when you give someone your money, they must be reliable and trustworthy. If you can't trust them, how dare you let them keep your money? When it comes to trading, having peace of mind is very important. That's because trading is very stressful, especially when you're a beginner. How can you make a good trade when you keep worrying about whether your money is safe? So first of all, you must start with a reliable stockbroker. Do some research and list all stockbrokers in your country. Find out the most popular and reliable ones, and eliminate all brokers that have many bad reviews and testimonials. The next thing that you should take into consideration is a trading platform. In order to trade effectively, you'll need a professional trading software that can help you perform technical analysis to predict the future movement of your stock. Normally, your stockbroker will provide you access to their trading platform for free. Some of them may charge a monthly subscription fee to their trading software and higher-level financial data. I prefer using the Thinkorswim trading platform from TD Ameritrade. It's an advanced trading tool, and the cool part is, it's completely free. You can easily sign up for a trading account from TD Ameritrade. You don't need to deposit any funds to open a trading account with them. After you have your trading account, you can use their professional trading software, Thinkorswim, for free. Besides TD Ameritrade, there are some stockbrokers that also provide advanced trading tools, such as Interactive Brokers and E-Trade. However, these brokers often require you to make an initial deposit to open a trading account with them. And the final thing you should care about is pricing. In my opinion, pricing is less important than the first 2 criteria, which are the reliability of a stockbroker and their trading platform. That's because as an investor, you need to make sure your money will be kept securely by a trusted broker. And you'll also need a professional, unbiased trading software to trade effectively. Normally, you'll be charged about $10 per trade. You see, the trading fee is not too expensive. Actually, if you can make money from the stock market, you don't need to worry too much about the trading fee. So make sure you'll always look for a reliable broker with a professional trading platform first, and then look at their trading fee later. Besides TD Ameritrade, my favorite stockbroker is Interactive Brokers. They're the cheapest but most reliable broker. You'll be charged just $1 for every 100 shares you buy. This broker offers a very good trading fee. However, to open a trading account with them, you'll be required to make an initial deposit of at least $10,000. Okay, my number 1 trading tip for you is that you can have 2 trading accounts. If you're investing in the U.S. stock market, you can open a trading account from TD Ameritrade and Interactive Brokers. The cool thing about TD Ameritrade is that you don't need to make any initial deposit to open a trading account with them. Once you have your trading account, you can use their trading platform Thinkorswim for free. You can use your TD Ameritrade account for analyzing stock charts and use your Interactive Brokers account for buying and selling stocks. As I've mentioned earlier, using Interactive Brokers is very cost-effective because you'll be charged just $1 for every 100 shares you buy. In case you use other stockbrokers, you'll be charged about $10 or more. So by having 2 trading accounts from TD Ameritrade and Interactive Brokers, you can trade with a very low trading fee. and you have free access to the Thinkorswim trading software. Okay, the second tip. You should always stay away from cheap and unreliable brokers. Many first-time investors look for cheap brokers because these brokers offer a low trading fee. But they don't understand that low cost simply means low quality services. You'll get what you pay for. You see, cheap brokers are consistently lowering their fees in order to attract more customers and gain market share. Some even offer free trades. They offer you a low trading fee, but they'll charge you for accessing high-level market data and their trading software. And they often have a low-quality customer service. There will be a lot of hidden fees, and you'll get what you pay for. So make sure you always stay away from cheap and unreliable stockbrokers. And the next question that I think many of you have right now is, how much money should I have to start investing? In fact, you don't need to have a lot of money to start investing. You can start with $10,000 and then you can add $300 or $500 to your portfolio every month. It's okay to start investing if you don't have $10,000. Maybe you have $3,000 or $5,000 right now. However, you should take the trading fee into consideration. That's because trading and commission fees charged by your stockbroker will potentially outweigh your profits if you trade with a small account. I strongly recommend that you only invest when you have no debt and you have some money that you can afford to lose. And always make sure that you'll invest in your education first. You cannot succeed if you don't know exactly what you're doing. If you don't have $10,000 to invest now, don't worry. Just save up more cash and start investing later. After you open a trading account, you can frequently add more cash to your portfolio so you can take advantage of the compound interest to grow your money. And the final tip is that you should avoid making a trade on mobile. That's because mobile trading sucks. I agree that some mobile trading apps are convenient on the go, but the downside is that you can't analyze a stock's chart accurately. You can't use some technical indicators properly, and that will potentially lead to a bad investment decision. Sometimes you'll face some connection issues, so make sure that you won't make a trade when you're using mobile. You should only use mobile trading apps for monitoring your stock's performance and reading market news. So, to wrap everything up before we dive into the next section, what do you need to start investing? The first thing you'll need is education. You must first invest in your education. You'll need $10,000 to start investing, and then you can add $300 to $500 each month to build up your portfolio. Next, you'll need a trading account. You can open 2 trading accounts, one from TD Ameritrade and one from Interactive Brokers, so you can take advantage of the low trading fee from Interactive Brokers and have free access to the professional trading software from TD Ameritrade. And finally, you'll need a laptop with an internet connection to start buying and selling stocks. And make sure you avoid making a trade when you're on your mobile. Only use mobile apps for monitoring your stock's performance and reading market news. Okay, now I'm going to share with you my favorite trading strategy that you can use to easily determine stock market trends. I'll teach you how to buy high and sell higher. How this strategy works is simple. We'll buy a stock when it's in an uptrend, and we'll consider selling it at the end of the uptrend. So, how can we determine the market trends? In order to determine market trends, you can use the simple moving average crossover strategy. A moving average is a trend-following indicator, and it's created based on past prices. How the moving average crossover strategy works is simple. We'll use a pair of simple moving averages. We'll wait until these moving averages cross over each other so we can determine the incoming market trend. In fact, you don't need to draw these moving averages by yourself. Almost all trading platforms will help you do so. You just need to know what they are and how to apply them in your analysis. There are many different ways to use the moving averages. I personally prefer using the 180-day and the 60-day simple moving averages. simply because they seem to be more accurate than other moving averages. And the most important thing is, these moving averages work for me. Okay, here's an uptrend signal. When the 60-day moving average crosses above the 180-day moving average and both lines slope upward, this means that your stock is in an uptrend. So if you follow the trend to buy the stock, there's a high chance that the stock price will keep going up and you can make a profit. On the other hand, when the 60-day moving average crosses below the 180-day moving average and both lines slope downward, this means that the prior uptrend has stopped and a downtrend will begin. In this case, you can sell your stock to get out of the market and consider buying it back when the trend reverses. Okay, now you know exactly how our strategy works. So how can you apply it in your analysis? First of all, you'll need to set up the indicators. I'm using the thinkorswim trading platform from TD Ameritrade. As I mentioned earlier, it's a professional trading tool that you can use to analyze stock charts. And the cool part is, this software is free. It's very easy to set up the simple moving averages. You'll need to draw two lines, SMA, or simple moving average 180, and SMA 60. Up on the right hand, click on Studies and then select Edit Studies. There are a few tabs right here. Under Studies tab, type in Simple Moving Average. You'll see the Simple Moving Average indicator here. Since we need to draw two lines, the SMA 60 and the SMA 180, we'll add two simple moving averages to the stock chart. Select Simple Moving Average and then click Add Selected twice. Because the default moving average time period is set at 9, you'll need to change it to 60 and 180. Double-click on each moving average and change the time period to 60 and 180 respectively. I personally prefer changing the SMA 60's color to blue and the SMA 180's color to yellow. You can use different colors if you like. After changing the time periods, simply click Apply and OK. When you do, you'll see the screen here. The software automatically helped us draw the two moving averages. Now, we just need to apply our strategy to determine the incoming market trend. Okay, now let's take a look at an example so you can understand clearly how the simple moving average crossover strategy works. As you can see from the chart, the blue line is the 60-day simple moving average, and the yellow line is the 181. Now, let's see what the moving averages can tell you about the market trends. When you analyze your stock's chart and you find that the SMA 60 is above the SMA 180 and both lines are sloping up, there's a high chance that the stock is in an uptrend. So, in cases like this, you can follow the trend to get in the market. However, when the SMA 60 is going to cross below the SMA 180, this may necessitate the selling of your stock. In this case, you'll need to pay close attention to the price movement of your stock. If the blue line crosses below the yellow line, and both lines are sloping down, this signals that there may be an incoming downtrend. As you can see on the screen, when the SMA 60 crossed below the SMA 180 at point A, the share price of Apple began dropping. And when the blue line crossed above the yellow line at point B, and both lines sloped upward, the trend reversed and the share price of Apple started going back up. The blue line crossed below the yellow line once again at point C, and you can see that both lines are sloping down. This signals that there will be an incoming downtrend, so it may not be a good idea if you're looking to buy shares of Apple at this time. Actually, we don't know what will happen with the stock tomorrow. However, the moving averages show that there will be a high chance that the share price will continue to drop until the SMA 60 crosses above the SMA 180. Okay, now let's take a look at another example, Starbucks Corporation. Firstly, let's take a look at point A. As you can see, the SMA 60 crossed above the SMA 180, and both lines sloped upward. This was an uptrend signal. The stock price kept going up until the SMA 60 crossed below the SMA 180 at point B, However, as you may notice, the two lines weren't sloping down. The blue line sloped downward, but the yellow line didn't. It was sloping up. So this tells us that there was just a short-term fluctuation, and the stock was still in an uptrend. Even though the stock price had actually dropped, it was just short-term. In cases like this, you can predict that the downtrend is just temporary, and the price will potentially go up again soon. As you can see from the chart, after the short-term drop, the stock price recovered and went back up quickly. Our strategy requires both lines to slope upward or downward so we can confirm the incoming trend. So if one of the two lines doesn't slope correctly, we will not consider it a valid trend signal. When the blue line crossed below the yellow line at point C and both lines were sloping down, we might consider this a valid downtrend signal. As you can see, the stock price continued to drop until the SMA 60 crossed above the SMA 180 once again at point D. Both lines started sloping upward, so we could easily predict that there would be an incoming uptrend. Okay, now let's take a look at another example, Papa John's International. As you can see on the screen, the SMA 60 was above the SMA 180. This means that the stock was in an uptrend. The blue line crossed below the yellow line at point A, but both lines weren't sloping down. This tells us that this was just a short-term fluctuation. The blue line crossed above the yellow line at point B, and both lines were sloping up. So you could easily predict that this stock's price would potentially go up. Looking at point C, the SMA 60 crossed below the SMA 180 again, and both lines were sloping down. In this case, you could easily predict that there would be an incoming downtrend. The SMA 60 crossed above the SMA 180 again at point D, and both lines were sloping up. So, this is an uptrend signal, and you could easily know that the stock price would potentially go back up soon. Okay, another example, Spider S&P 500 ETF. This is an ETF that's designed to track the overall performance of the S&P 500 index. Now, let's take a look at point A. The SMA 60 crossed above the SMA 180, and both lines were sloping up, so this was an uptrend signal. The blue line crossed below the yellow line at point B, and both lines were sloping down. In this case, you could easily predict that there would be an incoming downtrend. As you can see on the screen, there was a significant drop in this ETF's price. This was caused by the stock market crash in 2008. When the market crashed, many investors lost their fortune. Our simple strategy could have saved them from the crash if they knew how to utilize it. The stock market went back up again when the SMA 60 crossed above the SMA 180 at point C. Both lines were sloping up, so this was a valid uptrend signal. Looking at point D, the blue line crossed below the yellow line at point D. However, the yellow wasn't sloping down. So you could easily know that this was just a short-term fluctuation. The stock price would go back up shortly when the blue line crossed above the yellow line at point E. As you can see, our strategy's been working very well. If you can utilize this strategy, you can easily predict incoming market trends. And this is the key to your success. But wait a second, don't just take my word for it. You can easily sign up for a free demo trading account from TD Ameritrade to test everything out. Sign up for a free demo trading account. You'll have 60 days for trying the thinkorswim trading platform. The demo trading account will come up with a virtual cash balance of $200,000. And you can use this money to test everything that you've learned so far. Go and test all the strategies that I've taught you. I guarantee you, if you can apply everything I teach here, you can get wealthy and build a better financial life. Here's what's inside the thinkorswim trading software. You can use this tool to practice buying and selling stocks. Try to make different types of orders. Buy different types of investments, such as ETFs, stocks, or REITs. Once you become familiar with the stock market and gain enough knowledge and experience, you can open a real trading account and start multiplying your money. So now you know exactly how to start making your money work for you. And I want to tell you an interesting fact. This strategy has been working very well for me, my friends, and thousands of my students. This strategy also works for stocks, ETFs, REITs, or any of your investments. And also, I want to guarantee you, what you've learned so far will work for you too. And finally, I want to thank you for learning with my video lessons. And thank you for spending your time with me over the past few days. Thanks, guys.